right, so that's basically Ruchi Sharma with views there. It's an important event right up. Our global guest is now ready with us to provide us with an overview of how things may look. Fook Hien Yap is Senior Investment Strategist at Standard Chartered. He's joining us to take some questions. Mr. Yap, great to have you with us here. Thank you very much. I hope I got the name right. Feel free to correct me if I did not. What is your sense in terms of...
That's fine.
how are you looking at things, Mr. Yap, in terms of where we are? I mean, we've seen very large moves in the rates market in the US, in Europe as well, particularly in Europe last night. Because they seem to be repricing what central banks will do. I mean, this is a repeat of what we've seen earlier. Things cooled off, and now we are kind of getting back on that once again. Will that hit risk markets, in your opinion, or it's an old story now?
Yeah, I think I've been listening to what you were saying, your show, for the last couple of minutes, and Jackson Hole has come up quite a bit. I think, no, not unlike others, Jackson Hole is a very key event for us. I mean, I'll talk about Jackson Hole a bit, and I come on to Europe, which you're talking about. So Jackson Hole, I think, it's been a big driver, but I think, Chair Powell is probably going to reiterate what a lot of the other officials have been saying. That they are very committed to fighting inflation. They do not see the US in a recession yet at the moment, but inflation has to come down, and therefore they are very committed to that. Bear in mind, though, the Fed meeting is in September, next month, on the 20th, and a week before that, on the 13th of September, you're going to have CPI data. So I think we're going to get a lot of message that they're going to be watching the data. CPI data is going to be quite key. The market is 50-50 at the moment, roughly, between whether we get a 50 basis points hike or 75 basis points hike. And the Fed, I think the messages that we get from Jackson Hole is going to be quite key in terms of driving whether your US dollar, the DXY, does that get into a 20-year high or not? And then the 10-year yield as well, as you guys have been talking about that, whether the 10-year yield, does it go up to test 3.5%? So there's a lot of things that the market, I think, is watching for. We've seen the US go up to the 200-day moving average, and it pulled back. And we had a very good Q2 earnings results behind us, but that's behind us now. So at the moment, it pulled back from a technical resistance level, and we're going to be watching the Jackson Hole for a lot of indicators. And in some sense, next month is important, but I think longer term, the question is, where are rates going to end up? What's the terminal rate going to be? Is it going to be the 3.5%, or is it much higher? And I think that's going to be the bigger driver for the markets over the next 12 months, if you look at where the rates end up. And Europe, as you say, yeah, I think there's a lot of risks in Europe. And, we have a core view ourselves of European equities. And that means we expect Europe to trade in line with global equities. Well, that is our view for the next 12 months. And there's a lot of bad news out there. I think we agree. I think front and center of that, of course, is the gas prices and coming into winter, and how that's going to affect things. But and then there seems to be a little bit of a harder move from Russia, and in terms of the Nord Stream and the gas and the supply productions that they're cutting there. But we think a lot of that is being in the price, actually.
Sure. Okay, all of that in the price. Yeah, good morning. Let's just revisit the first point that you made on the move post the Jackson Hole on the dollar index and on the bond yields. If right now the market perhaps wants to believe that maybe 109, 110 is it for now for the dollar index. But if we have a bigger move, maybe in October onwards, then do you think the emerging markets will revisit their lows, or is it something that the market is now, has digested and is ready to move on?
Yeah, that is a very key driver you point out. Emerging market equities, as you know, is very much correlated to the dollar, and the strong dollar has been a bit of a headwind for emerging market equities and China. But I think we do have a view that the DXY could be going through a process of peaking. I think a few things need to fall in place. We need to see a peak in expectations, and as inflation comes off, I think that will, we're looking out on a 12-month view as well, and we see the DXY actually going through a peaking process and coming off that. It has been strong, and that's been a headwind for emerging market equities. And we do have a positive view, though, on China equities. We think in terms of putting aside the DXY and the headwind from there, the the direction of policy in China is towards easing. We think we've seen the cut in rates over there, and the policy direction, they've talked about a 19-point package right now to stimulate the economy. We think the direction in China is moving towards, supporting the economy, supporting economic growth, and it has a lot of negative news been priced in if you look at the valuations for China equities. So that's something that we see as a positive, actually, for emerging market side.
So that's interesting. Your base case is that the dollar index perhaps is peaking out, at least through the course of the year, and that has been the biggest headwinds for emerging markets. So once that is out of the way, do you think fresh money would come into markets like India? I know you mentioned that you like a market like China, but how is India placed in your emerging markets pecking order?
Yeah, we also see India outperforming Asia ex-Japan equities. So we have a preferred view for India equities. And, the view there, I think, very much is driven by what we see as still a strong domestic economy. And I think we're seeing very strong earnings growth, double-digit earnings growth, I think, for the third consecutive year in India for the Nifty index. So, and that's much better than other places. In other places like China and Asia, it's looking at single digit, and it's been actually being downgraded, whereas in India, actually, it's been quite positive. So, across, against that, of course, is always the valuation premium for India equities. It's trading at a premium to its other peers, and the premium is actually above the historical average. So that is a little bit of a headwind that we have to watch for. We have been talking a bit more about diversifying into your fixed income assets as well. But India equities itself, compared to Asia ex-Japan, is something that we do prefer because of the strong earnings growth and domestic economy.
Actually, the last word you said, the domestic economy, is it better to stick to domestic-facing stocks in a market like India, purely because of the challenges that are happening across the world? I mean, the global-facing companies that have an exposure to, say, Europe are getting hit very hard because of higher energy costs, freight costs, logistics, etc. So do you think it's better to look inwards in a market like India, domestic consumption, perhaps autos, banks, etc.?
Yeah, well, the view that we have is more on a large cap in India. We prefer the large caps to the mid and small cap. We think that's going to be a bit more beneficial in terms of the domestic macro strength. But also, being in a bit more of a volatile market situation, we think the large caps are the ones that we do prefer. And the other tilt that we have in India actually is towards the value-driven stocks. And that's another theme that we have globally as we see rates going up. That's actually beneficial, we think, for value. So, value did very well in 2020, 2021. This year has been a bit mixed, but we do see the strength of value stocks broadening out. And that is actually another theme that we prefer within India.
Okay, well, it was a pleasure speaking to you, Mr. Yap. Thanks a lot for joining in, and hope to speak to you very soon yet again. Well, that's a word coming in from Standard Chartered. They do say that perhaps the worst of the dollar rise is now behind us. That was a big headwind for emerging markets. And now that that's out of the way, they like emerging markets, especially markets like India. On that optimistic note, we'll take a quick break. On the other side, a list of top 10 stocks coming up. Don't go anywhere.